Investing is like buying a car. It's complicated. There is a ton of information online and it's complex and it's hard to understand and it can even be contradicting. There are thousands of options and you might have a preference, but you're not necessarily sure what your goal is or which one you want to go for. And you're not sure you can trust the sellers because they're trying to make as much as possible from you. And they might know more about what they're selling than you do. And it's also very expensive. A mistake can be very expensive. And think about investing. It's probably even worse. How many thousands and thousands are you going to spend on investing throughout your life? The thing about this whole video and the goal of it is to show you that this doesn't have to be the case. Actually, you can sum up literally what 90% of investing is about in 3 simple rules. And the reason behind that, and this isn't just me and my finance degree talking, this is literally the consensus of decades of finance existing, of stock markets being a thing. Most of your performance in investing comes down to avoiding 3 mistakes and 3 basic rules. And so in this video, I want to start by telling you when you know it's time to invest and how you know you're ready, how we can be smart and intentional about approaching it to avoid the pitfalls that it has. And to do so, I'll walk you through the 3 simple rules. And then, because I want this to be useful to you, I will give you the exact way that most people should apply the rules. So I won't tell you a specific stock to invest in. I won't talk about a tax strategy. This isn't the goal of the video. I will make maybe other videos about how I invest and, things you can do to maybe marginally just a little bit get a better return. But 90% of your performance comes down to 3 rules. And so let's start by talking about when you know you're ready to invest. It's simple. You need an emergency fund, and once you have any cash left over beyond that, you are ready to invest. And so what's an emergency fund? It's 3 to 6 months of salary or of expenses covered, ready in cash in the bank. And so you can have those in a savings account, gaining a little bit of interest, but essentially you want to have enough cash on hand so that if an emergency happens or if you can't work for 3 to 6 months, your expenses are covered. Once you have that, and everyone should have an emergency fund because it's very important, once you have that, any cash left over should be invested. And it's a good idea to do so because you don't want it to lose value to inflation, just sitting in a bank account not doing anything. And with that, I will tell you about how we can be smart and intentional about investing and then give you those 3 rules. And again, I just want to say that personal finance by definition is very personal, right? So it will depend on your situation. But those 3 rules, the magic thing about them, and it really, I don't know why there isn't, everyone talking about this. Maybe it's because there's just so much money to be made from complicating an industry that really isn't that complicated. 90% of your performance comes down to these 3 rules for most people, and they apply to everyone, and they are just mistakes to avoid. All right, so the preface to those 3 rules is that they are about how to approach the risk that investing comes with. There's always a risk with investing. It's inherent to the market. It's what investing is about. You get a return from taking risk, which means investing in companies that might not do well. And what matters is long-term performance. This has always been the case. It's very hard to time the market. Extensive research has shown it. You can't really get a bargain or a deal in investing. It's just not how it works. Markets tend to be very efficient. And so, again, those 3 rules aren't about a trick. They're not about hacking anything. They're really about what to avoid and how you can optimize most of your performance. 90% of it comes from those 3 rules. All right, so the rules. The first one is diversify. This isn't anything new, probably heard it before, but it's extremely important. You cannot put all your eggs in one basket. And what this means is you don't stock pick. You're not buying into a specific hot sector. You're not choosing 3 companies that you are putting all your money into. You're not just putting it into real estate, right? You are diversifying. And the reason you should diversify is that it's the best protection against bubbles. If a sector crashes, if a specific company crashes, you're not overexposed to it when you diversify. So things make up for things, and that's just the way to go. So that's the first rule. The second rule, where it gets a little more interesting, is all about emotions. Do not follow the crowd. You probably know this, but as humans, it is our inherent nature to go for things that are hyped by everyone and to avoid things that are negatively looked upon by everyone. It's just the way we work as humans. We are a crowd, society living kind of people. And so we're very emotional about decisions, whether we like it or not, me included, right? I say all of this, but inherently, and it's just the way it is, I will still be emotional when I invest. But we really need to try to acknowledge this and avoid it as much as possible. And the way we do that is that we're not just buying with the crowd when they buy, and we're not just selling with the crowd when they sell. So when media outlets make a lot of money off of giving you, this hot company that they think is going to go huge or telling you about what to avoid, don't listen to that. You will focus on the 3 rules, and the second one was to avoid just following the crowd. The third rule, and this one is really important as well, the three are extremely important, but this one's very important, is to control your costs. Over time, costs add up. And what I mean by costs is the percentages that you're losing when you're investing in different ways. So there are two ways to invest typically. Some active ways and passive ways. Active ways are when you are having your portfolio or what you're investing in being managed by a person like a financial advisor or a broker, or a company like a brokerage or a mutual fund or whatever. And so these active funds or active investments typically charge 1 to 2% fees every year on your investments. In comparison, passive investment methods like index funds that you just buy, they typically charge 0.1 to 0.4%. I'll give you an example. I use Wealthsimple in Canada. Even their managed investing options typically charge 0.1 to 0.4%. Same for Vanguard's indexes and all of those. So these are the two main ways, or the two differences in fees in this space, active and passive investing. Now, these seem tiny, and I'm the first to say it, 1% doesn't sound like much, right? It's just $1 off of every 100. But over time, it adds up tremendously. And I will try to put up a graph that sort of shows this or kind of proves it, but it is a dramatic difference. And so the big third rule is to control your costs and lower them as much as possible by going for those options with lower percentage fees and just lower costs overall. That's kind of it. But there's one more thing I want to tell you, and it's the easiest way to apply all of this. So now you know when it's time to invest, once you have that emergency fund and you have cash over it or above it. Now you know the three things to avoid and the three rules, which are to diversify, to not be emotional and follow the crowd as much as possible, try to, and to control your costs. The easiest way to achieve all of these three that will work for literally most people, again, I'm not a financial advisor, but this is the consensus of years and years of research of the stock market even existing, is to buy an index fund and hold it. That's it. It's not fun, it's not exciting, but that's how it should be. And arguably, it is the best way that everyone should kind of do to apply those three rules. Buy something like the S&P 500 index, the Toronto Stock Exchange index, whatever it is, buy a passive fund and invest in that, and you are set up, you are following those three rules, and that is your way to go. Beyond that, it just becomes about how much do you want to invest and how much you want to keep in cash. That becomes a discussion, right? For most people, that's how you personalize this way of applying the rules, is maybe I am more risk tolerant, and so I want more return, and so I'll invest a lot more in risky assets like stocks and that index I just talked about, and keep less in cash in a savings account than perhaps a friend of mine that is, less risk tolerant and that'll keep more cash. So it's just that proportion that changes in this method, but it really just is about holding a passive index fund. That is it. So the last thing I'll say is that outperforming this index fund and this method I just talked to you about involves a lot of research, a lot of time, a lot of effort, and risk. And so it's rare that it happens. You can look it up, and there's a bunch of proof around this. Hedge funds rarely beat the market, and those who do are those who are put in the media and promoted, and those YouTubers that talk about beating the market are those who make videos about it. You never see the majority of them that don't making any videos about it. But those who outperform this take immeasurable risk, and that typically requires a lot of money as well, things like venture capital and things like that. And that's it. You're now smart about investing. Best of luck. I'll be making videos on how you can optimize this. For example, I invest in REITs for real estate. There are some tax strategies that are interesting with tax sheltered accounts, so I'll be making maybe some videos about those. But that's it. Good luck, and see you in the next one.